Every time we experience a bear market like this one, we wish we would have known about it sooner, so we could have simply booked our profits to prevent seeing our portfolios in the red. In this video, we'll tell you about two leading indicators that can help you predict an upcoming bear market or recession, namely crude oil and the inverted yield curve. American financial analyst John Murphy, who is renowned for his proficiency in intermarket analysis, identified a link between oil prices and the stock market. He claimed that since the 1970s, the charts have repeatedly shown that when oil prices peak to new highs, a recession is generally on the horizon. Higher oil costs cause a fall in disposable income, which leads to less spending and ultimately dampens global economic growth. Increased inflation is another negative side effect of increasing crude oil prices that leads central banks to raise interest rates. Let's test this theory on the basis of past events. Number 1. The 1990 Persian Gulf War. On August 2, 1990, Iraq invaded Kuwait in an attempt to conquer the country's vast oil reserves. While the two major producers of crude oil were at war, the price of crude increased by more than 100% from $21 to $46 per barrel due to a shortage of supply. Number 2. Asian financial market crisis. As a side effect of the Middle Eastern crisis and rising crude prices, the Asian financial markets started witnessing a fall in their currency values on account of rising current account deficit due to the rise in crude prices. This led to a lot of South Asian countries, including India, to witness a fall of an average of 50 to 100% in their currency. Talking about the current situation, crude oil prices have been rising dramatically following the Russia-Ukraine war, as traders expect significant supply shortages due to sanctions placed on Russia. A year ago, crude oil rates were $63.81, and now those prices have touched a peak of $130, more than doubling in a year. To sum it up, if the energy sector, particularly crude oil, experiences an upmove of more than 50% in a short period of time, it's a sign of an impending recession, because such a phenomenal rise is always the result of a significant shortage of supply. Bond markets are considered as a leading indicator of future economic health. We are able to follow these indications through yield and yield curves because they typically move 9 to 12 months ahead of the economy. Yields are basically the current rate of interest on the government's bonds. TradingView.com allows you to follow them using these symbols. The interest rates on bonds that have maturities ranging from 2 years to possibly 10 or 20 years are represented by a yield curve. The short-term interest rates are therefore lower than the longer-term in a normal yield curve because bondholders should receive an additional risk premium for the interest rate risk. On the other hand, an inverted yield curve occurs when short-term rates start to exceed the longer ones. The stock markets are at their peak when the yield actually inverts. We can observe the subsequent decline in 2000 as the dot-com bubble burst. Another instance of the same thing happened between 2006 and February 2007 when the yield curve was inverted and S&P had just made up its losses from the 2002 crash. This was followed by the infamous housing bubble burst of 2008-9, which caused the S&P index to experience a waterfall decline until 2009. The current yield curve inversion has worsened when the 2-year yield surpassed the 5 and 10-year ones on July 13. This inversion again signals an approaching recession. Now, every financial and economic indicator is pointing towards a recession in the future. Who do you think will be right? The politicians or the economists? If you liked our content, don't forget to subscribe to our channel for more such interesting videos and also hit the bell icon to get notified whenever we post.